All right, welcome back to part 2 of the Real Estate Roundtable here from the DoubleLine offices. I want to pick up right where we left off. We were talking, on the first part, we were talking about how behaviors and preferences could change or have changed already and what that looks like for the outlook for a lot of your areas. And so, Ryan, you were starting with this, talking about just kind of the behaviors of folks, of your clientele and what they are actually trying to achieve here. And so, as you think about the future, what behavioral changes do you think have transpired in the last 6 months since we've had the COVID pandemic, and how has it changed the way you guys are trying to prepare for the future of your business at Convene?
Yeah, look, I mean, the one big thing that we're focused on is this shift to, at least kind of as it relates to future of work, is this shift from the company makes the space decision to the individual makes the choice. When do I work from home? When do I go to the office? When do I work from a third space? And what's happening, I feel like, and this has been a trend that we've been talking about for the last probably 10 plus years, is this idea of the consumerization of real estate. And this isn't true in life sciences and I think some of the other asset classes we're talking about, like data center, which is still very much B2B, but multifamily, student housing, office real estate, like these are all becoming very consumer facing businesses where brand starts to become really, really important. And if you look at a lot of like the new business model innovation that's happened within office with companies like us, or even within residential, with companies like Common that kind of started out as co-living companies, but have now become really branded multifamily platforms. I think they're taking advantage of this kind of shift to the individual, really owning and making the decision. And I think that has broad implications for where people live, where they work, and it's something that we're paying very special attention to as we build out not just our physical network and making sure that we're putting Convene locations in the right geographies, but also as we start to think about our digital platform and how do we leverage technology to connect with a customer base that's going to be more and more fragmented and is going to want more of the control in their hand, which means like our booking engine becomes more important. How people order food or reserve a space or access a Convene space. It's all this digital things that we need to sort out so that we can kind of stay ahead of that trend.
Yeah, Ken, you were mentioning about urbanization, the high end, and Morris, you kind of picked up on it as well, that's suffering because some of the appeal of being in the urban center is the liveliness. You talked about it being a ghost town, Morris. How are you thinking about that and trying to identify those trends? Are they short-term, or do you think there will be a revival as we get back to having the economy back open? I'll open it to all of you, actually.
Well, I think there's definitely the knee-jerk reaction to, escape LA and escape New York, like the old Kurt Russell movies, if anyone remembers those. Except he won't be riding a wave out of downtown Los Angeles. And look, you can see that. We used to joke that Connecticut, you couldn't sell a house. We have some friends that live out in Connecticut, and they'd show us these homes. Like coming from California, you can buy like a mansion with a par 3 in your backyard for the same price as 7,000 square foot lot in LA. And now you can't find them. They're all sold out because there's been this knee-jerk reaction of all the people in the city fleeing. And I think you'll probably have somewhat of a more permanent desire to have that more space, right? If I don't have to trudge into New York every day from Connecticut on the train. In fact, I don't even want to take the train these days. Maybe I want a house in out in Connecticut or wherever that may be. And even in some of the parts of Connecticut that people didn't want to be in because it took so long for the train to get to, or you have to take the train for an hour and then drive 45 minutes. Even those places are doing well, right? And so there's ability to work from home has opened people's minds to, I can live anywhere, right? And to your point, maybe that means that I don't need to go into that main hub office in New York, and I can go into a Convene somewhere. And maybe that Convene doesn't need to be in downtown LA. It can be in Torrance, California, which is a suburb near me, where there happens to be, used to be the largest mall in America before they built the Mall of America. And there's a Sears there that probably doesn't need to be there anymore. But what can go in that space?
Wants to be a Convene now.
Could be a Convene, could be a Amazon logistical center is something that probably makes a lot of sense. So I think, and it seems like the millennials, they want to be on the move. I've been looking at these, I got 3 little kids, and we've been looking at vans and trucks and things like that. And somebody's like, why don't you look at these Sprinter vans? And I started researching Sprinter vans, and there's this big movement out there of like, live in a van. Have you seen this? I know a kid from college. He's
By
been
the way,
living in a bus for like-
RV sales are up too right now. Big.
They're booming. I know this kid from college. He's been living in a bus. He's got this like Instagram, YouTube thing. It's a nice bus, but he's been living in a bus for like the last decade. And this just seems to be popular. People don't want to be stuck in one place. And the things that tie you down are having to go into the office or having kids that have to go to a school. But what if it becomes more widely accepted that kids can remotely school in with Zoom? So your kid can go to a high-end private Zoom school that's accepted by the universities. It's just technology is allowing us to be more mobile. People don't want to be necessarily in the same place all the time. And so I think the ability to go into a place like Convene, that is only increasing in demand. I don't, right this second, people don't want to do it because of they don't want to get sick, and there's this concern from a health standpoint. But I think the longer term trend is that it's definitely becoming more acceptable for companies to be more spread out. Even I know at DoubleLine that mentality is becoming more acceptable. And financial firms are probably the last to think so, because it's been ingrained in our mind, you need to come to the mothership and sit on the trading desk because that's how it's been done since the 1800s, right? And COVID has sped all these changes up.
I was going to say, by the way, I did ask this of Ryan earlier. Has anybody tried to rent out a trading desk at Convene? And he said, yes, he has a client that's already done that. So again, just an anecdote. Morris, what do you think about this? The behavioral, the changing preferences? Maybe we can talk about things outside of just multifamily.
Sure. I mean, I think it's important. If you think about commercial real estate, it goes in cycles, right? The reurbanization sort of dynamic that we saw, where we're talking Columbus, Ohio, we're talking, cities such as Nashville, cities such as Pittsburgh. That whole reurbanization trend was that people were fleeing those cities, and Detroit included, because industries change, and there's no longer a desire to want to be in those because industries change, and as such, rents fall to a point where home prices becomes cheap. Real estate prices becomes extremely cheap and affordable, and thus you would attract, people from out of the area to want to be in those areas. And over time, it's going to fill up. Downtown LA is the same dynamic. And in the early 2000s, no one wanted to be here, but rents are cheap. There's availability of space. There's restaurants starts coming in, and so that whole live-work dynamic is what attracts people to Manhattan. I mean, there's that dynamic of the attractiveness of living in cities, and at least from my seat, then you can parse out into, you have to have a view of what's going to happen from a cycle perspective, where we are relative to that. And I kind of feel like we are changing that sort of viewpoint because of technology, because of COVID in itself. But the viability of these cities, it really comes down to, at a certain point, businesses are going to come back because the rents are it's the affordability component will come around. And with businesses coming back, people are going to come back.
I think that's what people extrapolate a lot of times about a recession. Like historically during a recession, businesses go under, but someone steps in and replaces that business. So a restaurant goes under, there's another willingness to take on that restaurant. And so I think that's what happens when we have this short-term extrapolation of just the recent past. You end up with this dynamic to say it's going to change, and you're not being really a good student of history, right? Cycles, we're cyclical for a reason. I don't know, maybe it's because we cycle around the sun, the moon cycles around us. I don't know what it is, but we have this human innate thing of cyclicality, right? And so I think that's the important thing. And so what we didn't see, though, is the cleansing, right? So we saw that we've papered some of this over by lending, by people stepping in. So as you think about that too, where we didn't go through, at least thus far, it's only been 6 months, so it's hard to say we're out of the woods yet, but we didn't go through that kind of cleansing process and recapitalize and starting over. You let the existing kind of continue. So bad businesses continue to thrive, even though maybe they shouldn't. How do you think about that in your market? And I'll throw that to you as well, Bill.
I think it's it's important to try to extrapolate to your point and think about where we are. It's only been 6 months, and and what makes it challenging from an investment perspective is comprehending, all the fiscal stimulus as well as monetary stimulus being thrown into the entire system to support good and bad businesses as a whole, and that's the difficulty in terms of extrapolating what's going to happen. I think in the intuition, at least, if it's a bad business, it's going to perpetually be a bad business. And so if you borrowed money, you're able to borrow money, you have access to capital, and you're a bad business, and your model is you're not shifting with the times, eventually there's a reckoning day. And from our seat, you can look at some of the regional malls in the commercial real estate world where, from a business model perspective, if all the inline tenants are going out of business, is that mall going to survive? And that sort of dynamic of thinking through what can presumably happen, that's how we try to get around it, right? I do think that we're in the early stages in terms of a reset. You're definitely seeing retail rents fall. You're going to see office rents also fall as well, and occupancy numbers drop. It's a matter of time. Just the amount of small businesses that are going out of business. It's something we didn't cover, but it's pretty alarming. You can look around at even the city of Los Angeles as a whole in terms of restaurants going out of business, and we haven't even talked about the white collar jobs that in terms of small businesses that are offering businesses supporting small businesses as a whole. So, this is something that, from a fallout perspective, we're still early on, and so as an investor, you really need to be very careful and select the right investments.
Yeah, it's been easy for large corporations to access the market. We know this with the Main Street lending program because that's to go through the banking system. And remember, the bank underwrites loans, right? So they're going to say, hey, I don't think your business is viable. I'm sorry, even though I'm supposed to provide loans to this, I don't like the underwriting on this because you have some risk there. So Bill, back to the question too of thinking about kind of the changes in preferences and just the cyclicality of your business within real estate too, and how we've thrown the money at it. Did we solve the problems? Is it just, my first saying is always that you can't make a bad business solvent by just throwing money at it, right? So what are you thinking about the real estate side from your perspective?
Well, I think that a lot of the questions that you're posing have to be put in it's too hard to answer right now, right? I mean, when we were in the apex of the volatility that was late March and early April, one of the things we did was we reached out to people sort of across our network, right? And all the stocks that we looked at were down, and they were down from 25% to 40%. And what we were figuring out was the guys who were running the data center businesses and the tower businesses whose stocks were down 25% were sitting there saying, our business is fine. Our business has potentially been marginally improved by this. We're seeing strengthening demand for our connectivity services. We're seeing increased demand for on our fiber networks, that sort of thing. Okay, so that was a pretty good setup for those businesses where you had the stocks down a lot and the businesses were doing as well, if not better. And then you had other sectors like office, like hospitality, where the stocks were down 40%, let's say, on average, roughly. And they don't have any visibility as to how this plays out. And to your point, we're still in the middle of this, right? There's no vaccine, and we're all sitting in an office that's otherwise mostly closed. And none of us really knows how this is going to play out. And so, do you want to make a bet that's predicated on your vision of how this virus plays out over the next couple of years? You can if you have a strong enough view, but you also don't have to. I think what we're looking to with regard to those kind of assets is this public-private dynamic that we talked about before. The private market in real estate is much bigger than the public market. And there are a number of instances where things in the public market have sold down to a degree where we can say, well, that's comfortably trading at a 30 or 40% discount to where a knowledgeable private buyer would purchase this thing. And so there are some opportunities where you can look at markets where there's beginning to be price discovery on the private side, and then compare it to what's available in the public markets and find these big spreads. And I think that's sort of the way to play the public market right now. There are a bunch of really attractive secular winners that you can underwrite to attractive returns. And then you can selectively go through these pockets of distress and find things where you say, well, that's a really high quality real estate asset trading at a really material discount to where a private guy would buy it. And then there's a lot of stuff that's in between that's just sort of too complicated, and you just have to sort of be comfortable with that.
Yeah, I like that answer. It's just too complicated to answer. I thought that was good, but you explained it very well.
Well, it kind of seems like the stock market's kind of like that too right now. Like the stock market's telling you, I want to buy growth because they're growing today, they're probably going to grow tomorrow, and everyone's looking at the value stocks and saying, okay, well, it's trading at a discount for a reason. Maybe the business is flawed. I mean, look at banks. Like, if you're Wells Fargo, people look at your stock and they say, okay, I want to buy it at a discount to book. What's book? These little branches of Wells Fargo's out and, wherever you are, right? And is that worth anything? And so should I even take a yo on that and hope that it comes back? So let's stick to what actually has a future. That's why people are sticking to multifamily. People are sticking to industrial. People are sticking to housing-related things like SFR or even manufactured housing. Manufactured housing is booming. Manufactured housing lots, just like the pads, are up 26% year over year.
Well, it helps that they've got one of the best business models out there. And in real estate, exactly, right? I mean, that's the other thing in investing, right? In real estate, we're talking about the way that, the sort of ebb and flow of demand is impacting these different business models. But if you really parse it and go sector by sector, it's not shocking to find out that some of the subsectors that have been hit the worst also have kind of lousy unit level economics. And manufactured housing, you're renting what's effectively a parking space in a market that's got a lot of demand, right? Your cost of operating it, of sustaining it from an OPEX and a CAPEX standpoint, super low. And it's really, really supply constrained, because if you want to, go out and try and build a new trailer park,
there's
right?
massive zoning issues with it.
Yeah, you can't add supply, and so you've got this great intersection of growing demand, constrained supply, terrific unit level economics. No shock that
Also,
those
it's
traded
very affordable, right?
Yeah,
unless you're in Malibu, right? Going up those trailer parks.
Most expensive trailer park in America.
In America, they're like $1 million lots a piece, and you got a great view of the ocean off of PCH. But that's not for the low income type of cohort, right? Yeah.
But it seems like that's the story. I mean, the story of winners and losers. I use it a lot when I talk to investors. It's what the Fed buys, what the Fed doesn't buy. You can apply it across everything that's going on right now, right? And it's why take that bet on hoping that mall comes back where you can find something that there's going to be some growth in. It just doesn't, unless, like you said, it's trading at some massive discount or it's some trophy property. And so I think, but you're not really seeing much transact, right? Like the bid ask is wide. If I'm a seller, I don't want to sell yet. I'm going to hope that things get better. And if I'm a buyer, I want to buy at a big discount. So you really haven't seen kind of the sales happen, right? I mean, it's starting to pick up. Anecdotally, I'm hearing about, at least in LA, you're starting to see, maybe some of it's, Prop 15 driven panic selling, but you really haven't seen the transaction volumes pick up. It's like a stalemate right now.
Yeah, I mean, it's down 68% if you want to think about transaction volume on a year-over-year basis. And this is part of the reason why we're talking about we're still early, all right? The market hasn't fully reset, and the benefits of the part of the explanation in terms of lack of transaction volume is this time around, again, there's availability of financing, right? Banks are lending, the GSEs are lending as well. Obviously, there's ability lending for the assets that are one would presume is something you can lend on, not going through some secular strain. And that availability of lending has essentially pulled back the desire. Let's just say if you're a borrower and you have a loan mortgage coming due in October this year, and you need to refinance, and during the global financial crisis, that's really difficult to find a reasonable loan that you can get out. And I would say more oftentimes than not, during the global financial crisis, that borrower would have to default or come up with massive additional equity just to make that loan work, right? And under this construct, I mean, today we ran an analysis. The borrower today is actually borrowing at the same coupon as they were pre-COVID, like pre-March, just in a traditional CMBS conduit transaction, that coupon, it's not just think about spread, but that coupon is effectively markedly the same. And that's partly due to the Fed lowering rates, the base interest rates, even though risk spreads have widened out, but the coupon is the same. Leverage has dropped slightly, but that's very helpful for the market. But that's also an explanation of why, at least for now, we haven't seen transactions go through. Once they do, though, that's the scary part.
Right.
There will
it's a
be
remarking,
resets.
right, of the whole industry, right?
Absolutely.
Right. So Ryan, I want to bring you into this too and put on your old hat before you were in the Convene side. And everybody's skirted the issue up here so far about the elephant in the room on the leisure sector. I want you to start off and tell us about it. Every time I ask Morris, he keeps coming back to multifamily because it's the safe thing to talk about. Let's take some risk. Okay, let's talk about the hotel industry. And my view on the hotel industry is it's predicated upon business travel. That's the bulk of it. Yes, there's leisure. You'll see it in anecdotal properties in kind of flagship areas. You're in the business of providing amenities and services. How do you think about the hotel sector today?
Look, I think there's some big question marks, coming out of this, which are really, I think, structural questions around the type of demand that exists and the quantity of it. My sense is the leisure side, although maybe it gets more regionally dispersed in the short term to kind of drive markets, is going to come back first. But I think we all know that a huge part of the underlying revenue in the hotel industry is group travel, and then business travel. And there are hotel brands out there where 70% of their annual revenue comes from business travel. And I think, as Bill said, it's still too early to tell what, if any, long-term structural change there is in group travel and individual business travel. Because if that demand goes away, you can make a really logical argument, as I could in retail and as I could in office, that we're oversupplied. And I think that has really big implications where technically the office market, retail is going through this painfully right now, but then hospitality is going to have to be resized. And I think that you've got a lot of legacy, I'd say low to mid quality inventory, especially a lot of the big branded stuff that honestly to a younger consumer is like not relevant anymore. And so I think that there's like a lot of big factors that are all going to come together and converge over the next few years. And the biggest to me is what happens with business travel and large kind of scale group, which at this point in time is a massive question mark. You can make an argument in either direction. So I do think it's going to take time. And look, you've got to have a real conviction today, I think, to make a bet in that sector.
All right, with that, Morris, since I called you out,
Yeah.
Hotels.
Yeah, so I mean, I think I would agree from a comeback perspective, leisure assets logically will likely be the first sort of asset to come back, just given the I would say the psychological mindset that everyone collectively is in, right? Now, as you kind of segment the hospitality sector into other areas, where we see in our view is in similar ways that you kind of explained it, the potential strain right now is, when is business travel going to return? When is group business going to return? Because there are a lot of hotels out there, and we can even look at the ones downtown right around here that are solely dependent on business travel. And if we take a step back and think about the questions that we were talking about earlier in terms of trying to answer, what trends are we seeing? What shifting trends are we seeing as a whole? And I would say that right now, from a business travel perspective, clearly it's in the back of everyone's head that no, I'm not going to get on a plane to travel for business, and the desire to want to do that because the technology is a lot less than what it was before, and we kind of expedite that, or we've been experimenting on that for the last for the past 6 months. So from a strain perspective and how that resets the market, We do think that there's a lot of concern with respect to the business travel segment. Trying to forecast and trying to think about from a timing perspective requires understanding or having a view on when do you think the vaccine and or its effectiveness is going to come around. It'll take time for people to be comfortable to get back on a plane to travel for work. And from an over-hotelization perspective, you can say New York City has a lot of hotels, and a lot of hotels there most likely than not may have potential alternative uses to the extent that the financial economics don't make sense to run a hotel. The over-hotelization sort of component is very real. It's just very early to trying to gauge how over-hoteled are we, right?
So Bill, I think I know your answer, but hotel REITs?
Well, yeah, so there's the cyclicality question and the demand question, but I think when we think about hotels, let's start with the big question, which is this business a good business? And hotels are a really, really tough business. And hotel REITs have got themselves into a place structurally in the hotel ecosystem where a tough business is really tough. So think about the pathway from dollars available, sort of, money paid to rent a room on a given night, and how that flows through to free cash flow for the owner of that box. Hotels are a super tough business, right? And tougher all the time because money gets spent off the top for surfacing that customer. And some of that goes to Google, and some of it goes to Expedia or to Kayak or these other search engines. And then if your hotel is branded, right, you've got some sort of a managed agreement with the brand, and money has to go to the brand. And so you, as the owner of that box, own sort of the whip end of the economics, right? You're absorbing all the volatility because you're paying these guys right off the top, and then you still have all of the capital expenses. And hotels are a tough business from a capital expenditures standpoint because lots of stuff that they have to spend money on wears out really quickly. It's furniture and it's pillows and it's rugs and all this kind of stuff. And at the end of the day, turning $1 revenue into $1 free cash flow in the hotel business, particularly if you're structured as a REIT, is hard work. And so it's another one where you say, well, is it worth trying to even figure this out? I don't know.
Okay. Ken, do you miss hotels from business travel since you're the resi guy?
Depends on the hotel. Depends on the hotel.
Yeah, and did you stay at the one that advertises, that you'll be smarter? So let's transition. I want to end this on ideas, but before we do, when I look across the space, what I'm hearing too is that this is kind of a macro trend that we're trying to capture here, but the macro play isn't the way to really do it. It's really getting into the individual assets. So as you guys think about this too, what has changed in your analytical process over the last 6 months? So what have you done differently to kind of analyze the state of the world? Have you introduced new tools, alternative data sets? What things are helping you get a better sense of the cash flows or what you're looking at to value these companies? So maybe I'll just start back with you, Bill, and we'll go across the table and then end with Ryan.
Yeah, I mean, for us, we're trying to make it as easy as we can. So in a particularly volatile environment, we're trying to make the simplest decisions we can. And for us, we've really been able to leverage insights from our operations on the private side. So to the extent that we're investing in businesses in the tower space, the data center space, fiber networks, and these kind of digital infrastructure assets that are very much the growth drivers for real estate, we get a lot of benefit from collaborating with our colleagues who manage our data centers and our towers that we own in our private equity vehicles and on our balance sheet. And so I think in an environment where everything is more volatile than we're used to, we're trying to keep it simple, and we're trying to sort of leverage the areas where we think we've got real advantages.
Right, so data access is very important to you today, right?
For sure.
Yeah, right. Morris, what's different now?
Yeah, as a lender, you have to you're subject to the whim of the availability of information that you can garner, and you have some control with respect to how much information you can get from the borrower. So this is the time where as a lender, if you have an asset management team, and you have the wherewithal to garner up-to-date information. And when I say up-to-date, monthly info with respect to what's going on underlying that property, that's extremely valuable to us and to an investor because that's real-time information that you can use to make the decision a buy, sell, or hold, right? And so, what we've seen is, we've pressed. You can lean on servicers in the commercial mortgage-backed securities world. You can use the industry sort of control rights with respect to the investors to I would say flex your right as a owner of that as a lender to garner this information as up to date as you can, and that for us is if you were asked us a year ago, when things are smooth sailing, you don't need to be that proactive. Right now, you absolutely do. And I hate to go back to apartments again, but when we think about apartments, we want to know exactly what's going on in terms of the rent roll on a month-to-month basis, because apartment rents are shorter-term leases, and that lease can change. I want to see where you're signing new leases, where you're, how many people have moved out, what your collection rates are, and that same thing applies to office buildings. The same thing applies to hotels, which is a daily sort of information that you can garner. So that access to information and staying on top of the asset is extremely important. I would say it's a sensitized environment for lenders because we're not equity investors. We're capped from a return basis at the dollar amount and the interest amount that's pre-agreed upon. So we need to make sure that this information is available so we can make that decision.
Okay, Ken, what's changed in your process, or what new data sets do you look at?
Yeah, I think since we were the epicenter of the last crisis, the playbook was pretty similar because we saw how borrowers behaved. We buy bonds backed by pretty homogeneous asset, single family home, 3-bedroom, 2-bath, 2,500 square feet, roughly across America. So we could look at what happened during the crisis and then how borrowers behaved then, how they behaved during hurricanes. I'm going to use that example again. And what you see is that there's, a recession is kind of like a hurricane, right? It's this disaster that comes in, but eventually it goes away. And you see a spike in delinquency, the recession goes away, people get jobs, not everybody defaults, and we can look at those numbers. So that's what we did. And we saw that in the global financial crisis, loans that had little or no equity originated in 06, 07, they got to about 16, 17% delinquent, but only 9% of them defaulted. So like almost, half or so ended up not defaulting. Borrowers that bought the house in 02, 03, they had more equity. They bought the house, the price of the homes went up. They piled money in principal payments, interest payments. Less of those, more of those borrowers ultimately didn't default. And when you look at hurricanes, about 90% of the plus of the borrowers ultimately don't end up defaulting. So we looked at those curves of what the delinquency rate goes up, delinquency rate comes back down, and shockingly, the drop in defaults and forbearance is almost the same as kind of most hurricanes, at least the path right now. So that's kind of what we're following right now. I think one of the things that's different now, and we haven't talked about it at all, is global warming. I'm going to bring it up. It's a big topic in California right now. We have a lot of terrible fires, and some people are saying, I'm leaving the state because of global warming and the fires, but it doesn't just affect California. What about we've seen like record hurricanes right now in the South. So
they've even had to go to naming them in the Greek alphabet because we ran out of names, right? Because they alternate letters, and now we're in the Greek alphabet. And it's weird to just see Hurricane Gamma coming at you. It reminds me of my days at college, Hurricane Gammas. Anyway.
So, I remember distinctly when Katrina hit, we used to sit there and we didn't have all the data. We had to go through term sheets and look up by hand the percentage exposure to, like New Orleans and the Gulf states. One of the things we avoided, Fannie and Freddie package up bonds and you can buy kind of the first loss piece. It's razor thin, like 20 basis points of loss, you're wiped out. And, it takes a lot of loans to default to get to 20 basis points of loss. But what if you have high exposure to those hurricane-related areas? And that's something that is a risk that we couldn't quantify. I don't know when the hurricane's going to hit. I don't know what's going to happen. It's going to happen. Just like there's going to be the big one here one day. might as well just happen in 2020. Let's pull the Band-Aid off. Let's get it over with. That's something that's now a serious kind of risk. So we look at bonds and we say how much exposure it has to these kind of higher risk geographies, like Napa Valley is burning right now. It's not a big theme yet in the market. I think it's going to start to become more important. People are going to start wondering if there's certain pockets of risk. If you own, real estate on Balboa Island in Newport Beach, is it going to be underwater, right? I mean, New Orleans was underwater when the levee broke. So, it doesn't really affect, I don't think, big office buildings and things like that. But as far as where people want to live, it could, there's a lot of things that we didn't spend a lot of time on. Natural disasters is one. We didn't even touch on taxes. I mean, that's a lot of the reason people are going to some of these tertiary cities like Nashville and Austin. It's not just because it's getting too crowded in New York. It's because people are tired of paying taxes. So I think that's another thing that's on the horizon to think about.
All right, Ryan, to you. You can't use taxes. Ken took that in global warming. But what else are you looking at?
Look, I think for us as an innovator and as an operator, we're very focused on, I think, what we're hearing from our customers and what we're seeing in our customer data. Especially for us as we work our way out of this crisis, we're not too dissimilar from how a hotel owner is probably thinking today, and we're very focused on momentum indicators, right? So. And a lot of that stuff is actually happening outside of outside or in the top of our funnel. And so we're spending a lot of time with, our sales and marketing team, our demand gen team, our rev management team, making sure that we understand the data that's happening on the front. And then I think from a strategic perspective, really spending time with our customers at a senior level, whether that's the CEO of a high growth company that we work with, or you're talking to the head of workplace strategy or global real estate at our customer and saying, look, we know today's about how do you safely get people back to work, but we know real estate is a long cycle, and how is this starting to really impact your longer term strategic planning? Are you going hub and spoke? Are you thinking about distributed work where you're going to look at new geographies? What percentage of your workforce are you going to really commit to being at home? And if you can kind of take that quantitative and qualitative stuff together for us, it starts to give us some sense directionally for where the puck is going. And, I said it before, like for us, the future is hybrid for Convene. And, we're investing a lot of time and capital and resources into our virtual platform, in particular on the meeting and conferencing side of our business. And then I think everything else that everyone talked about, where is population movement going? Is there, we didn't talk about geopolitical risks. Like there's macro risk at the regulatory level, both locally and federally, that didn't really have to think about so much. And how does that impact where businesses and people are going to want to live and work? And then it's our job to kind of try and hopefully jump ahead of that stuff from a location perspective. But it's going to be a road. I'm not seeing anything clearly yet. I think as Bill said, it still feels too early. But hopefully, as we work over the next 6 to 12 months, we'll have a lot more, clarity on what the next 2 to 5 years will look like, for our industry.
Okay, so we're getting close to the end of time here. Our audience has limited attention span. So they've tuned in, they've listened to 2 of these, they want an idea. All right, so each one of you, you're going to be on the spot. Give us what your best idea is within your sector of the market. So it can be thematic. Please don't give any specific stock tips or anything. But thematically, what do you like right now as an investor? What are you focused on? Where's your highest dollars allocated to? Looking at you, Bill, start us off.
Sure. So, for us at the corporate level and in our funds, we're leaning into the digital infrastructure theme. We think that the digitization of the economy has a long, long way to run. We think that a lot of these businesses are aligned with that demand growth, but they also have competitive advantages and great unit level economics and can deliver really attractive returns for what we think is going to be a very, very long runway of growth ahead.
Yeah, I think it's amazing. I learned that from you many years ago, that this digital footprint is a big component of the REIT world. And I just think it's amazing that a lot of people just think it's multifamily, it's just office space or retail. but the tax structure is beneficial and the likes, and it's been a huge, robust growth engine.
Yeah, I mean, just to give a framework of how much the transformation is already underway, if you looked at the REIT space 10 years ago, the top 5 or 6 REITs were shopping malls, office buildings, apartments, right? And if you look at the top 6 REITs now, they are all digital infrastructure.
Good point. All right, Morris, favorite part of your market?
So I would say it's a play on housing, right? On residential assets. So within the multifamily sector, we're seeing
Had to say it
a
again,
lot of.
right?
I'd say it again. We're doing a lot of unique transactions. Whether it's lending against multifamily buildings and/or multifamily building-backed bonds, now's a time where there's uncertainty surrounding the commercial mortgage-backed securities arena, and there's a lot of uncertainty with respect to how many people's moving out of these cities, how many people's moving into the city, and where rent's being signed, and you're definitely seeing some value. And again, it comes down to what do you think the building is worth, ultimately speaking, to one, as a lender, and two, ultimately, what is the exit? And we're definitely seeing some discounts being priced in because of the uncertainty that's going on. So that's from our seat, as a debt investor, an area that we feel is a safe area to be in, and you're also getting unique returns.
So on a risk specter, if you're talking about safety and high quality stuff to put in the low risk funds, but what about in the more higher octane?
So I would say on the higher octane side, I mean, there's plays in office, and from an office building perspective, somewhat contrarian in terms of all this talk about disruption of office and technology. But at the end of the day, if there's a solid lease in place, and that goes into the legality of the commercial real estate world in terms of leases, if there's a solid lease and it's long-term, the cash flow predictability of some of these office deals make a lot of sense. And whether it could be in New York City, it could be in San Francisco, if there's a strong lease in place and you are comfortable with, as a lender, what the value exposure is as a lender, there's definitely deals to be done, right? We're definitely touching that area. On the hospitality side, again, a very volatile area, a lot of uncertainty surrounding it, and we're definitely seeing areas where, especially in the economy segment, limited service, extended stay type assets, where there's actually an affordability component. It's actually cheap to rent. You can rent it for longer periods. You can drive to those assets. It's spread out across the country as a whole. From a dynamic perspective, we're actually seeing those outperform a lot of the other hotel property type sectors as well, including the public REITs. I mean, you look at hospitality REITs as a whole, limited service segment has actually outperformed. I would say if from a risk-taking perspective, those areas on the hospitality front, if you want a higher octane type of return, there's definitely a pragmatism into stepping into that.
Sure.
So.
Okay. Ken, same question to you. What do you like in the residential mortgage market today?
Sure. Well, look, we've talked a lot about strength in housing. So how can I take advantage of that? I can either lend to the owner of the property, somebody that's going to buy it and live in it. I can lend to somebody that's going to buy it, fix it up and sell it, or buy it and rent it. And I can give a loan to one of those owner, users, renters, whatever the purpose of the property is. Or I can find a way to extract the property value by buying the asset at a discount. So I can buy a delinquent loan, a non-performing loan at a discount, and then try to get to the property. And maybe I can even keep the property and rent it, which is a strategy that some people do. Or you sell the property, or maybe you get the borrower to reperform. Hard for the average investor to get access to that unless they're buying a fund that's doing that. So I would say, for the average investor, other than buying a fund that invests in mortgage-backed securities, you can look at other ways to play it. I don't know about the valuations today, but you can look at REITs that are doing the single-family rental business. You can look at MH, manufactured housing REITs. You can look at mortgage REITs. I'd probably stay away from agency mortgage REITs because they're just levering up very low yielding agency bonds. But on the credit side, they use a little bit less leverage. Again, valuations have come up since March, but perhaps there's some value there. You just wait for the right time to buy when some vol picks up. So seems like there's strength in housing. Good news for a lot of our listeners is 2/3 of Americans own a home. So the good news is I don't think your house is about to collapse in price, even though we're in a recession.
All right, you heard it from the used car salesman. All right, doesn't think the used car guy doesn't think house prices are going down.
Car will run for the next 10 years, I promise.
Yeah, just throw some sawdust in it. All right, Ryan, your favorite idea out there too. As you know, Ken and I have a good relationship. We like to joke around here. So
All right,
anyway.
perfect. Look, I'd say adaptive reuse takes center stage. And I do think that we've got certain asset classes like retail, office to some extent, even hospitality, where I think creative entrepreneurs and developers are going to have to think about what those future uses can be. And I think that there's going to be a lot of alpha there. It's going to be complex, I believe, for the capital markets to underwrite that stuff, because I do see these things becoming very almost like vertically mixed use. I'd say the second thing personally, I've been very active, within the prop tech ecosystem as an early stage investor privately. The infrastructure, the technology infrastructure for the largest asset class in the world is being built today. It's being digitized. And there is some incredible entrepreneurs, some amazing new technology and new business model innovation that's coming. And so, when I think about exposure to real estate now, it's not just about the assets in my portfolio or the PE funds or the REITs that I own, but also making sure that I'm getting that exposure to the technology infrastructure that's really going to power the future of the industry. And I'd say lastly, there's some office REITs, I think back to what Bill was talking about with the public private, that to me start to feel oversold. When you start to see a BXP with the quality of the portfolio that they have and the diversity with an 8% dividend yield, I do think that there's some interesting, if I was an individual investor, taking a look at some of the REITs that maybe have been over traded out is worth at least a peek.
Yeah. I love that the owner operator is the only one to use the term alpha in describing the opportunity sets. That was great. That was great. So I want to thank the panel. Thanks, Bill, for making the trip over to the DoubleLine office. Ryan, appreciate you zooming all the way from New York City. We'd love to have you in person, but we understand the quarantine issues. I want to thank everybody for listening to this roundtable discussion. Hopefully you found it informative. We're going to plan on doing a couple more of these before year end on what we think are prescient topics. So stay tuned to the DoubleLine channel as we post more content. It's youtube.com/DoubleLine Capital, and you can find all of our videos there. Thanks again, everyone, for listening, and thanks for your support at DoubleLine. Thanks to Bill. Thanks, Ryan. Thanks, Ken and Morris. Appreciate your time today.